Hello, welcome back to American History. Today we're going to continue talking about FDR and the first New Deal and examine some of the programs that were made in result of the first New Deal in the first 100 days and examine what these programs attempted to accomplish. So with that, we will dive right in. So a lot of times this is referred to as the New Deal alphabet soup. And the reason for this is that many of these programs were created with that they're only known by their acronyms. These acronyms stood for different things, and obviously we'll talk about each one of those and some of the main programs that were started. But each of these programs, what their goal was to create more jobs and increase economic activity. So just a quick survey of some of those, just kind of a sampling, if you will, of the New Deal alphabet soup. So the first one is FDIC. And what the FDIC does is the Federal Deposit Insurance Corporation. What this did is it came from the Glass-Steagall Act, which we'll talk about. It provided basically government insurance for bank deposits. Now, what this means is that if you put money into a bank and the bank is to invest that for some reason and were to lose it, the government would back that money up. So that what it does is it ensures confidence into the consumer that their money would be safe in banks. Now, the only way that banks could receive this insurance is if they passed inspections and adhered to federal guidelines to ensure that they were in line with the guidelines, so that one, they would be protecting the insurers, the depositors' money, but also two, that the government would be able to back it up if something catastrophic were to happen. So I would say overall this is fairly successful. This company still works today. And if you put money into a savings account, it's most likely going to be federally insured through FDIC. The next one is the SEC. Now, this is the Securities and Exchange Commission. What this commission did was regulate and oversee the stock market. Its goal was to make sure that no fraud was occurring, that people were playing by the rules, and also just to kind of keep a tab on what was going on in the stock market, as to make sure that nothing either bad in the sense of breaking rules was happening, but also bad in the sense of the market getting out of control. So basically what this sought to accomplish, and it did, as it still does today, it allows the people to understand kind of which aspects of the stock market are doing well, and kind of just reveals the curtain so that they know what parts to avoid. The next aspect of the first New Deal is the Glass-Steagall Act. Now, what this act did was separated commercial from investment banks. And the basic difference is, are you putting your money in so that it can be put into the stock market, or are you just putting it into a safe place to keep it? And it created a separation between these two, so that if a bank were to want to invest money, they would have to inform you before doing so. So that way you're not just putting your money into somewhat of a black hole. I would call this one probably successful because it allows banks to, one, be more upfront about what they're doing, and also two, gives the consumer more control over their money. Our next one is the Homeowners Loan Corporation. Now, what this organization did was it took government money and it bought out mortgages. So people who were behind on their house payments could sign up with the HOLC, and the government would pay the bank the money for the mortgage. What they would then do is refinance it. And what refinancing means is basically reworking the paperwork so that you'll pay it for a longer time, but they'll do it at a lower interest rate, so that each month when the interest collects, it'll actually be a smaller amount each month, so that hopefully overall, one, it's easier to pay those payments each month, and also two, you'll be able to save some money in the long run. Now, what this did in its effect is it made people able to afford their homes more. They had cheaper home payments so that they didn't have to lose their home and they wouldn't end up in Hoovervilles, and definitely something that you would want to avoid if you were living in the 1930s. So overall, was this good? Yeah, it helped the people who it helped. Part of the problem, though, is that where was the government getting that money? Well, usually that money comes mostly from tax dollars, but people were not paying that much in taxes because they didn't have that much money to start with, even though taxes had been raised at a certain point, so that as a percentage more money was coming in. the amount of money that people were making, because so many people didn't have money, they weren't actually being able to spend it. So what does this kind of open the door to? Deficit spending. And we're going to talk about more of that in the future. But this is kind of just for your knowledge, putting a coin in that bank or in that piggy bank, or put a jar, maybe probably a better way, maybe since we're not to confuse you with banks, but it's putting a coin in that jar that kind of adds up the idea of this is money that we don't have. We're spending money that we don't yet have collected for. So in the short term, great. In the long term, we'll see. You'll have to be the judge of that. All right, so the next one is the FCA, the Farm Credit Administration. This is similar to the HOLC in that it helps farmers refinance their mortgages for their farms instead of homes. So basically works the exact same way as the HOLC. Government buys the mortgages for the farm and then refinances it so that they are able to pay their loans in a little bit more easily of a way. Okay, so then moving on to the next one. Right, so the next we have the Agricultural Adjustment Act, or the AAA. What this did was it had the government pay farmers to not grow crops or raise livestock. So if you were a farmer and you were trying to sell your crops so that you could make some money, what the government would do is they would come in and say, okay, here's a plot of land that you were planning on growing some crops. How much money do you think you'd make off of that? And they would use kind of the market forces to determine like what the going rate was. And whatever that rate was, the government would just pay you that money, but you wouldn't grow the crops. What this idea was is that farmers who would be selling these crops, typically the prices would be way too low and they would end up growing more food than it was actually needed. But by decreasing the amount of food that they grew, the hopes was that they would raise prices. And so if the price of crops raised, they would then make more money off of it. And the government was doing this in a way, one, that they would be making more money off of it, but two, also that they would have the prices raised in two ways. So there's kind of two aspects of it. One is the government's paying them not to grow crops to decrease the supply and hopefully increase the price. And also two, the increased prices are allowing them to make some more money. Did it work? Yes and no. It was successful in the sense that it was good for farmers. One, they were making money by not spending money in terms of labor and supplies and kind of the wear and tear of equipment. And yeah, they were also making more money off the higher prices. The problem is that who's paying for that? All the people. And do the people have money to pay for it? Not really. So it was good and bad at kind of the same time. Farmers really benefited from it because they had an increased income. However, people having to pay for these increased prices made it harder for them to pay for the food. And kind of in the broad scheme of things, if it's harder for people to pay for food, one of two things could happen. Obviously, I'm sure you could think of more scenarios, but I'm thinking of two that kind of go with each other, is that if people only have so much money to spend each month and they have to spend a certain amount of it on food in order to not starve to death, they spend that money on food, and the amount of money on food is being spent is now increasing, so that they have less money to spend on other things. Their disposable, it's eating into their disposable income. They no longer can spend money on things that they don't necessarily need. The things that drive the growing economy. So now people are only buying essentials, and by only buying essentials, the economy is not expanding. The other aspect of this is that maybe they can get by with eating less food. And so when they do that, now farmers are actually potentially losing money because people are buying fewer crops because they can't afford to buy them. So that's kind of the AAA, kind of its rundown. Moving on to the CCC, or the Civilian Conservation Corps. This offered young men the opportunity to work. Many of them were unemployed and needed an opportunity to do something. So they did a lot of stuff like in the realm of conservation. So planting trees, managing forests, building reservoirs, kind of just wildlife stuff in general. And it was a good opportunity for these people. They were given an opportunity to work and a new opportunity to try to start building up some savings. The issue with this is, while it was successful in what it immediately sought to accomplish, at a certain point they ran out of jobs, and either people were not able to get these jobs, or they completed the goals or the projects they were working on, and then the people who had these jobs in the short term didn't have jobs in the long term. So that's sort of the double-edged swords of the CCC. The next one is the NRA. This was the National Recovery Administration. It was created by an act passed by Congress called the National Industrial Recovery Act. What this government agency did was create essentially regulations for businesses. They set prices, set wages, limited the amount of hours people could work, allowed unions to have more power, and tried to create industry-wide rules of fair competition. What this did was basically the government tried to run the economy in certain sectors. Just 2 years after it was passed, however, it was declared unconstitutional. And the reason for this is it's not within the realm of what the Constitution says that the government is allowed to do. It was an invasion of sort of the free market principles that the United States had been based on, and to a certain extent was driving business in the wrong direction. So that's the NRA. The last one is the PWA and the CWA. These are the Public Works Association or Administration and the Civil Works Administration. What these groups did was they did very similar to what the CCC did, but they did more about roads and buildings and bridges, things that the government was using, schools as well. And these created jobs for lots and lots of people. The issue with these organizations, however, was that they spent way too much money. They were always over budget and were constantly drawing from money that had not yet been made. FDR eventually had to shut these programs down because of how much deficit spending was being put into place. And again, kind of going back to what we mentioned earlier, it created some solutions in the short term, but in the long term, didn't really necessarily provide the solutions that people were looking for. So overall, how did the first New Deal do? When we talk about the first New Deal, we're usually talking about roughly FDR's first administration. And during that time period, you can see the unemployment rate, which is only one measure, but it is worth considering. During that time period, unemployment did decrease. It went down from about 25% when he took office down to near 15% toward the end of his first term. But 15% unemployment is still very high unemployment. And while these programs that were put in place did do some to help the economy, overall, people were still struggling. Overall, it was still difficult to make it through. So what's the takeaway from all of this? The biggest thing that we can understand is how much the government's role was expanded. Whether or not these programs were successful depends on how you define success and whether you're looking in the short term or the long term. But each of these programs did something and was an attempt to try to get the economy to work better. So overall, was it successful? It's still pretty well debated, but hopefully this gives you a little bit of an insight into how successful each individual program was and the impact that it had on the economy overall. So thanks for tuning in, and hope you'll join us next time.